The setup will be more like 1929. Cathie Wood just warned of another Great Depression if the Fed keeps ignoring these signals. In an effort to limit inflation, the US Federal Reserve has been aggressively hiking interest rates. This might have detrimental effects, according to Cathie Wood of ARK Invest. In a string of tweets on the 12th of November, Wood draws parallels between the current situation and the circumstances that contributed to the Great Depression. Although the Fed's aggression is bad news, the fact they are starting to come in that show the US economy is indeed in a recession is a good thing. Moreover, there are numerous signs that prices are declining. And Cathie believes that this concern about inflation is misplaced at the moment. Deflation, in her opinion, poses a considerably greater risk. In today's video, we will see why Cathie thinks, quote, why deflation poses a considerably greater risk and it will be too late if something is not done about it. Those who believed that we were once again seeing inflation similar to the 1970s were criticized and made fun of for expressing it. We are not simply referring to stocks and bonds when we say that we believe in the pricing action. We are referring to cryptocurrency prices, commodity prices, and perhaps soon even real estate, from which many will get the conclusion that deflation poses the greatest risk. Furthermore, as you are aware, we don't necessarily view deflation negatively. We must overcome the severe deflation we are currently experiencing. The end of this month, in Cathie's opinion, will see the next Fed action. Additionally, the Fed has left its quiet period, so all of the governors have been strutting about saying things like, we're going 75 basis points, another 75 basis points. We believe that they will change their minds this month when we receive additional pricing cues, as well as earnings reports and projections from businesses that will likely indicate that the US is indeed in a recession. Bad news? Good news then. This year, we predict that growth will be limited. Moreover, innovation is all about growth, as you are well aware. Problem solving is another aspect of innovation. A recession will bring up a new set of issues. That's saying a lot, considering how much more developed the cryptocurrency business is now than it was during the boom-bust period of 2001. The S&P is down 20% year to date, while the Nasdaq is down about 30%. In other words, since the Cuban Missile Crisis in 1962, the stock market has not had a worse year than it is currently experiencing. Following that, we became a great society with weapons and butter, and inflation skyrocketed. Prior to that, though, the stock market was on fire. This has been the worst bond performance year ever, according to anyone's lifetime records. In order to try to retrieve the record, you may need to piece together the bonds in some cases. It hasn't been this bad since 1788. That occurred more than almost 2 centuries ago. As a result, the market has been extremely difficult for investors. We believe that there is hope at the end of the road. The Fed is receiving a lot of signals, and these signals will eventually be reflected in the PPI and the CPI, two lagging measures. They are receiving several cedars. The fact that we are in a recession will also likely be hinted at by many corporations in their earnings reports for the upcoming month. The Fed will certainly take a second look, we think. Large downturns are occurring quickly. They are just concerned with costs. They now have two objectives: employment and prices. To be honest, it's wonderful that they are concentrating more on the price rule, but we believe that a significant amount of systemic deflation will be the driving force behind the turnaround. When it comes to commodity prices, the price of gold, for instance, peaked in August of 2020. Additionally, it is at the lower end of a 2-year range at a time when copper, oil, timber, and iron ore prices have all fallen. There are indications from freight rates that supply networks are becoming much more flexible. Rates are decreasing, so the system has experienced significant inflation. The Fed raised rates in 1929 to squelch financial speculation, and then in 1930, Congress passed Smoot-Hawley, putting 50% plus tariffs on more than 20,000 goods. and pushing the global economy into the Great Depression, Wood says. If the Fed does not pivot, the setup will be more like 1929. The U.S. central bank is ignoring deflationary warnings, the super investor notes. The CHIPS Act, she cautions, may impact trade possibly more than we appreciate. Naturally, not all assets are made the same. Some might still be able to do well even if the Fed maintains its aggressive position. Global scale, we also observe a significant inventory overhang. Europe and China are also experiencing a recession. Additionally, retailers in the United States have overstocked shelves that will need to be removed by offering discounts. Therefore, we anticipate some significant adverse inflation shocks over the course of the next 3 to 6 months. The PCE deflator, which reached a peak in February at 5.3%, is being examined by the Fed. It's down to 4.6%, and we think some bad news has already come out and no one wants to accept them. In the upcoming 3 to 6 months, we anticipate seeing more negative data, as we already have. Therefore, we wouldn't be shocked to see it go lower in the next 3 to 6 months, if not into the 2 handles. And if there are enough consecutive drops, Cathie believes the Fed will drastically alter its course of action, such that the Fed will be encouraged by looking at the sequential data, many of which will be negative. They'll probably alter their tone and accept interest rates of 75 basis points this time, but 25 to 50 basis points the following time. After that, we'll have to wait and see. Even if we don't have the 2 handles, we're in the 3s and coming down quickly. Cathie believes they'll change their ways. She anticipates that there will be intense pressure on profitability until some of these price reductions are realized and inventory is sold off. In our opinion, the recession is mostly a result of declining inventories and global drag. Energy prices are ruining Europe. China is readjusting to the Commonwealth. Since there has been much denial that we are in a recession, we believe it will be more of an inventory recession. We will be coming out next year, but many forecasts believe we will be going in. Therefore, Cathie actually believes that as the year comes to a close, the market will be improving and some labor hoarding has occurred in this area. The employment statistics seem promising. The employment underbelly, which includes a lot of small firms, is not from if you peel the onion a little bit. Household employment has largely remained flat for the past 4 to 5 months. However, corporations were unable to find workers during the COVID and supply shock, which is why they are hoarding labor. They are therefore holding on a little bit longer than they usually would. Although Cathie anticipates that the inventory session will be somewhat jarring and that the unemployment rate will increase, she doesn't anticipate that we will reach the 6% mark. Like most growth plans, our strategy was severely harmed by concerns about inflation and rising interest rates. And as she already said, we believe things will change. We can observe that these 5 platforms are growing. These are the 5 types of invention. These growth trajectories are exponential. And in equities like Roku, Teladoc, Zoom, and others, we encountered numerous COVID-related comparative problems. As a result, there has been a lot of uncertainty in the market regarding very short-term indications. However, rapid expansion still exists. It has already happened, and we anticipate it will do so again. We see that the value of truly disruptive innovation, which is all that we concentrate on, is currently priced at about $8 trillion in the global public equities market. In the next 8 to 10 years, this figure will, in our opinion, surpass $200 trillion. Thus, it will increase from representing less than 10% of the global public equities market to, in our estimation, 60%. The traditional world order will be disrupted by these platforms in a way that we have never seen before, which is why we think it will advance to that level. Early in the 1900s, when the telephone, electricity, and the automobile upended the established order of things, we weren't even born. There are 14 different apologies involved, and there are 5 platforms instead of 3. Therefore, Cathie believes that if her assessment of the state of the economy is accurate and inflation is likely to decline pretty significantly, that will be really beneficial for growth stocks. In times like these, when performance is compressed, what she does is focus our holding on the names that have the highest level of conviction. As a result, we reduced her flagship strategy from 55 names to 33 names. Although it was really uncomfortable over a month, she performed the same thing with COVID, which lasted just 1 month. Additionally, it increased by 360% in less than a year from the COVID lows. Therefore, something was probably ahead of its time. We have greatly improved, and right now we have a lot of equities that Cathie would classify as deep values. The equities markets are now pricing in this probability as well. In fact, rising oil prices are a hefty tax on our economy's lowest socioeconomic demographic groups. Therefore, Cathie believes that the concerns in this area will change from recession to rising interest rates and higher inflation.